What is up, YouTube? This is the Working Investor. In this video, we're going to talk about the pros between the two types of investors out there. There's one type of investor that likes to focus on total return, especially when it comes to the portion where the dividends is derived from. And there's another party that likes to focus on total return, especially double the emphasis on where the NAV is going. To be realistically speaking, total return is an equation which, has two parts. It's got the NAV, it's got the dividends. It basically factors everything in. So, some people are focused more on one of the parts and some people are focused on the other of the parts. But honestly speaking, the total return mindset is the best way to give you the full picture. A lot of times, like fighter pilots, they don't know which way is up and which way is down. Sometimes you don't know. Sometimes it's confusing. And you have to learn to trust the gears on the plane to help you. You have to trust the gears, even though your intuition may tell you something otherwise. Sometimes you don't know if you're up or down because the price may be down, but actually in total return, you're up. If you had a stock that was $20 a share and now it's worth $15 a share, but you've got $10 worth of payments in the past 6 months, it looks like you're down, but you're really up $5. So that's why total return factors everything into the equation. But there are some good reasons to be focusing on the dividend yield portion, and there are some good reasons to be focusing on the net asset value. That's what we're going to talk about in this video. Let me give you guys an example. Let's say, and I'm sure you guys know what total return is. Let's say, XDTE, which is the income fund by Roundhill, and they do 0 to expiration options. And I went back from the time the fund launched from March 7th, and you could see here on the left, the price return is a measly 1.94%, barely 2%, barely 2%. It went up in price. So it doesn't look like it's very enticing. But if you look at the total return standpoint, it's up 20.24%. How is it up 20.24%? Because approximately a little bit over 18% of its total return came from the dividend part of the equation, and just under 2% came from the growth part of the equation. A lot of people like to invest in something called VOO, which is a cheap, effective way to be invested in the S&P 500, right? And you see here, and I went to the same time frame. I went from, you see, March 7th, because I wanted to compare the same time frame to same time frame. And you can see here, VOO, from a price return standpoint, is up 17.3%. 17.3%. That's much more than 1.94% or so, right? But, you'll see here the total return is 18.46. Why is it 18.46? Where did that little extra increase come from? It came from a little bit of dividends that it gives out. But you could see the majority of the makeup of this total return comes from the NAV, from the net asset value, the price of the stock going up. A small percent comes from the dividends, and that's the opposite when it comes to the income fund of XDTE, right? But, it's the best metric to know, comparing when it comes to income funds, they give dividends. The dividend is definitely a portion of your earnings, right? If you have a business that goes up in value, but also generates income, or you have a house, you buy investment property, it goes up in value when you sell it, and you're also getting rental income. So you put all that money into the equation, and you factor in your initial seed money that you're investing into the property, and you can see what your total return is, both from rental income that it's generating and from the value goes up in price. So that's how somebody has an easier way to get clarity to know if you're truly up or truly down, because there could be sometimes price going down, but total return up. So again, let's go focus onto the why some people focus on one versus the other, and there are some good reasons for it. So we spoke about, I think we kind of beat this to the ground, that it's honestly the best way to keep track if you're truly up or down, right? And basically, some people like stocks that kind of stay around. Imagine you have a stock that keeps going up and up and up in price and value all the time, right? Which is wonderful if you're a growth type of investor, right? But if you're an income investor, when the stock keeps going up in price, one way to, there's pros and cons to it, and we'll talk about the pros to it, but one of the cons is it gets increasingly more expensive to buy the stock that generates the income. Some people like stocks that kind of stay range bound, and then you can compound the dividends and buy it, more affordably. And if it's, as long as it's range bound, if it's constantly falling down, reverse split, falling down, that doesn't seem too good, because then your yield on cost keeps dwindling down, and that's not, then you're pretty much losing so much on the dividend yield that you seeked out to attain will not be there, and it'll be far from it if it keeps going down in price and reverse splitting, because then your yield on cost could drop exponentially over time. So that could be a very sour investment, right? But if the stock is range bound, if it ebbs and flows and if it goes to a bottom and it comes back up, that's good, because then you're kind of, you can almost like find it on the bottom, and nobody really knows where the tops and bottoms are, but you can try to get it on the cheap if you have confidence that it's going to go back up. Again, nobody really knows, but that's a pro, that you can buy things on the cheap. Now, the case for the focus of the NAV, again, it's of course total return is most important, but the people that focus mostly on the income funds that are more emphasis that their NAV is stable or going up, ideally going up, right? So a couple pros, I understand where they're coming from. Number one, it's nimble. If you're kind of a swing trader and you try to, get in and out of underlyings, and you don't want to stay in it for the long term, so you want to be nimble. And if you, let's say, get a dividend payout, of $1, and your $20 stock dropped to $19 on X dividend date, but when it comes closer to the next dividend payment, you're at $20.10. So you've recovered your entire net asset value that it dropped on the X dividend date, and then a little sum. You could decide just to get out of that underlying and move to another one, a clean slate. So it helps people be nimble if they're swing traders or the dividend capturers out there in the world, right? So those people like those type of underlyings, right? Another reason why it's the case for people who like to focus more on the emphasis of the NAV component of the total return is that if people who are in retirement and they want to start planning their bills, and they have bills to pay, and they don't want to have to go back to work, or they're depending on this income as supplemental income. Of course, a lot of wise investors out there would argue that when somebody receives dividends, one should not anticipate to use 100% of the dividends to use for life expenses, because number one, you got to factor in about a third for taxes. A lot of people say put away about a third for taxes. It's a good rule of thumb. Everyone's circumstances different. And also, I know for me, the way I think about it, my personal humble opinion, not financial advice, not tax advice, I'm not at all any of these specialists. I like to keep like a third for taxes, maybe a third to reinvest, and then maybe a third to use. That's like a good rule of thumb. Tell me what you guys think. I know people have different equations, but to think of reinvesting 100% of it, to use 100% of it, I think a lot of people would argue that that's not really the case. But people who really want to use 100% of it, if the NAV is extremely stable and it recovers 100% or close to 100% every single month, or ideally even goes up in price, it makes it easy for people to want to spend the dividends, right? Completely. And they can kind of, especially if the fund is consistently paying out a certain amount every month, it makes it almost like an annuity. You know what I mean? Of course, there's no guarantees in most funds, but if they have a historical track record of paying out stability, it makes, it's very, very easy to predict what the payment's going to be, right? So that's someone who's already in the retirement, not building up to retirement. Another reason for the camp that likes to focus most on the net asset value is that when it comes to margin call, right? If people are using loans to buy these assets, if your underlier net asset value drops in price, here's the caveat. If if you have a $20 stock that paid $1 and it went down to $19, but at the end of the month it's up to $19.50, right? If you used all of the dividends, then yes, you're down 50 cents per share multiplied by how many shares you have. But if somebody only used half the dividends, they only used 50 cents of the dividend, they left the other 50 cents to reinvest into it or keep it aside, then they're still at $20, plus they have that 50 cents to spend, right? So you have to do a little bit of bookkeeping and a little bit of tracking when it comes to the prevention of margin call, right? So people don't want to have to think about it. So it makes it easier for people to not worry about margin call if they're spending all of their dividends. So another thing is, this is my favorite point, and I think that everyone, whether of course, I'm on the camp the total return is the most important, but the camp likes to focus more on the dividend component versus the camp likes to focus more on the NAV component of this equation, right? So it's the higher yield on cost over time. This is what everybody, I think everybody unanimously would agree with this. See, if you buy a stock that the target, let's say it's 25% yield, right? 25% yield is the target that the fund manager tries to target. And let's say they're consistent on that, right? 25% yield. And the stock let's say is worth $25 a share. And it's a stock that goes up in price over time. Let's say they're able to give you more than 25%, but they keep some of that proceeds to help boost up the NAV over time. Over the years, let's say your stock goes up, eventually it doubles in price over time, right? And now it's $50 per share. And they're still targeting 25%. Well, because you bought your shares at $25, your personal yield on cost, the yield is still 25%, but your yield on cost that you spent, you're getting 50% on the money you spent, right? And it keeps going up. So it's kind of like the story of the tortoise and the hare, right? So, sometimes slow and steady wins the race. And, and over time, let's say the stock goes to $100, and now you're personally at 100% yield on cost. So you're getting, even though the yield is still 25% of $100, which is $25 a year, but you spend $25 per share because let's say you just bought a certain amount of shares and you just didn't do anything else, then you're eventually, your yield just keeps going up and up and up and up. If they're consistent, that's the thing. If they're consistent, of course, market conditions can vary all the time. There's never any guarantee. Implied volatility changes, market condition changes. Sometimes certain stocks may be very volatile and eventually they could stabilize. So there's no way nobody has a crystal ball, right? But that's something really cool. But then even people that try to go focus on the dividends, obviously it's good to buy underlyings on the cheap. You always want to buy them because the cost of entry is so important. Getting in at a good price, especially when you're building up the position, is so paramount because you don't want to buy things, I'm sure people don't want to buy things at all-time high. Who wants to go to the store and everything is extremely expensive? You always want to go on the times of the year when they have sales, right? So that actually, or at least average yourself in. So if you buy something expensive and the next day you buy something really cheap, make sure your cost basis is as low as you possibly can get it. So that's something really cool. Maybe I also want to add as well taxability. Again, not an accountant, but if more of the return comes from the net asset value, that's an unrealized gain until you sell it. And if less comes from as you're building up, it's a unrealized gain until you sell it, right? And then once you sell it, then it's considered a taxable event. But the dividends may not have that, tax, deferral, unless there's some things called return on capital and the 60-40 rule, which is 60% long-term capital gains, 40% short-term, which can help. It could be more of an idealized tax situation. It could also be if someone's doing it in their Roth, then who cares? It won't matter. Again, I'm not a tax advisor or tax avoidance specialist. I keep an eye on these things, but I'm not in any means an expert. So, I tell you to go seek your experts. Anyways, this is some food for thought. Tell me what you guys think. I don't knock anybody. I think that there's definitely some valid points in each way of thinking. I just like to present the 2 points. This is the Working Investor over and out. I hope you guys have a wonderful trading day.